Well, Federal Reserve Chairman Jay Powell met for dinner with President Donald Trump yesterday to talk about the state of the economy. Former President of the Federal Reserve Bank of New York, Bill Dudley, also weighing in on the Fed's recent action in a Bloomberg op-ed this morning, telling the public to stop worrying about the Federal Reserve balance sheet. His argument was essentially, nothing has really changed. We knew that the Fed was doing this. And the market has just sort of more woken up to it, even though the Fed has been telegraphing it for a long time. Dan Roberts.
Well, that's true and not, right? Yeah. Because there was, you can say it wasn't a major change, but the Fed did acknowledge the balance sheet as an issue, talked about banks wanting them to worry about the balance sheet. And so, there is that part of it. So I wouldn't say that nothing has changed at its status quo. I mean, I think that we have seen the last couple of times the Fed reacting more, especially to the markets, than we expected. So it is an issue of discussion. At the same time, also, it's a little bit of a straw man, because what the op-ed says is everyone is making such a big issue of this, and everyone's talking about this, and they shouldn't be. I don't think everyone's talking about it. I mean, in his world, maybe, in Dudley's world. But
okay, but the clutch the pearls moment in this op-ed, so to speak, is when he writes, I'm going to quote him, "Economic growth and corporate profits look set to falter in 2019 as the effects of corporate tax cuts waned and the labor market tightened. Demand for scarce labor should increase its share of income, crimping profits." Wall Street's not reacting to that today, shouldn't they be?
Well, and that's also not a fact either. I mean, that's an opinion. That's a prediction.
Well, and this to me, though, is where the anxiety is coming from. It's not so much about how investors are reacting right now. It's the question of whether or not the Fed has tools in the future. If we see a slowdown that we're not anticipating now, what do we do with monetary policy? The balance sheet itself has been seen as an insurance policy for a downturn in the future. And I think without that, people start to worry that we don't have the flexibility like in 2008 to respond to a really cataclysmic event.
And it's been a hangover from the last crisis as well.
Yeah.
But it's also interesting at the same time that we have the Fed sort of shifting its rhetoric, we're also seeing predictions for a recession get pushed further out, which are two things that don't necessarily square with each other.
And some of our guests saying, oh no, don't believe the hype about a recession. Everything should be fine. Remember just last week we had someone saying, bull for the next 20 years, there's no reason it should end. Right. So it really depends on whom you ask.
I mean, listen, I'm an eternal optimist. I think that there has been, to your point about a hangover about 2008, we've got a little bit of that in our financial speculating as well. People think as soon as there's a lack of expansion, let's put it that way, that we're in the depths of recession. That simply isn't true. We need to get away from this instinct that as soon as the expansion wanes a little bit, we're in do or die mode. We simply aren't, and I think that our monetary policy should reflect that.
I also think a lot of the people predicting a pullback soon, they say, oh, it's coming in the next few years. A lot of the argument now rests on companies that have come out and lowered guidance, said we're not going to do as well as we initially said. But in most cases, those companies have said that referencing China and the ongoing trade issues. So were we to get some kind of deal, that would be a pretty big band-aid that would actually change a lot of the discourse.
Well, except you could argue China's slowing regardless of what's happening with
Absolutely.